Welcome to CEO Money. I'm Michael Yorba. Thanks for joining with us. I have Scott Choppin. He is the owner of Urban Pacific Group of Companies. Scott, welcome to the show. Thanks for being here.
Michael, great to join you. Thanks for allowing me to join you guys.
All right, you're welcome, and you've got some great history behind you helping mankind through the real estate industry. And I'd like you to give our audience some background on you, the Urban Pacific Group of Companies, what you do that makes you so different, and how you help change the lives of so many people that you come in contact with.
Yeah, we appreciate that, Michael. Thanks so much for the great introduction. So I have about a 35-year history in the real estate business. Actually, my family was in the real estate development business starting back in 1960. Moving forward through my time joining the industry in the mid 90s. So really a family history, and then just an entire professional career organized around being really a real estate developer, not necessarily even an investor, but just purely a real estate developer creating new projects out of whole cloth. Our ambition and objective the entire time since forming the company in 2000 was to build, urban housing, urban infill housing, we sometimes call it. And as you alluded to in the last few years, really about the last 3 years, we've been focused on a workforce housing model we call the urban townhouse, or UTH. And our basically entire business plan has now focused on that. And UTH basically simply is a privately financed workforce housing model. Workforce housing meaning that we're building units to house working class, think blue collar families that in California and most urban metro areas through the United States are deeply undersupplied. And we're serving that marketplace using private capital. So we don't require government subsidy. We're really a capitalist-based model of producing yields to investors to attract capital while also providing this social impact housing story around housing middle-income, multi-generational families. So we're exclusively focused on that for the last 3+ years.
Now, when you say you're privately funded, is that from your own money, or do you have a group of investors that pools with you to create these new, fulfill the void in the market?
Great question. So we really predominantly raise capital from the marketplace. So we use a combination of individual high net worth investors, high net worth families, family offices, and institutions, combined with our own capital. So when I say privately financed, I'm really trying to differentiate it from the what I call true affordable housing model, which is taking government subsidy plus, available credit, debt, and equity in the marketplace to then finance a long-term, low-income, low-rent type of project. Think tax credits or home funds. Ours is using, what in essence any developer would use in the private marketplace to finance any deal. We just happen to be, in this case, applying it to this moderate income UTH model. So it would be a combination of all the above, although we've gotten the most traction amongst high net worth and family offices most recently. And really from the institution or constitution of the UTH model, we focus on these high net worth individuals and family offices.
What's the average price of these units that you're building? Because I assume that people are buying these from you. You build them, you develop them, and then are you selling them, or are you going into kind of a lease-back model?
So we are actually exclusively rental housing offer. If you look at the marketplace in California, and really this is true in many metro urban areas throughout the United States, the capability of middle-income families to both save the down payment and qualify on an income basis for housing prices in their local market is becoming a more and more difficult endeavor for these families. And particularly, our model is really came out of the California marketplace, um, you know, by design, meaning in California, probably out of the top 25 markets for housing prices across the United States, the top 18 are in California, and all the top 10 are in California. And so what you get is a whole sector of the marketplace in California that cannot afford to buy a house, and so they are renters by default, or sometimes even by design. They don't choose to try to afford the housing, and so our model, UTH, is purely a rental housing model intended to coherently serve families that don't or can't choose to purchase, and that we serve them with a 5-bedroom, 4-bath product. I didn't talk about that earlier, but one of the unique characteristics of this is that it's a townhouse model with 5 bedrooms, 4 baths. One of the bedrooms is on the ground floor, making it multi-generational. And we rent these units for about $3,500 to $4,000 a month on average. Now that sounds like a high rent payment, but that puts us at about $2, maybe $1.80 to $2 a square foot on a value ratio, meaning rent divided by square feet, in a marketplace that generally exceeds $3.50, $4, $5 a foot, square foot rent, basis in the marketplace. So we're providing a unique product that lives like a house, has a 2-car garage, and rents coherently for these families that are in these 80 to 120 median income categories. And this is a completely underserved marketplace in California.
What about the geographical location? Are you focused mainly, because I think you're in Long Beach, right?
Yeah, we're based in Long Beach, correct.
Is that your geographical market, or are you expanding that to other areas?
So initially, about 3 years ago, we created the innovation that came really from my background, having worked both in affordable housing and the market rate sectors and the apartment development. But in the beginning, we created what we call the demonstration phase, and that was all very super local, in our backyard, take away all the variabilities of trying to execute out of market. And we've basically are now completing that demonstration phase. In fact, our last project is going to be complete in about 2 weeks. And so we'll expand further in Southern California, and that's where we've generated all of our projects to date. But we are looking at scaling this product really across California. So think San Diego, Bay Area, Southern California, Los Angeles, and Orange County, where we're already active. But we've underwritten these projects in Portland, Seattle, and Denver, and this product in the rent categories and the cost categories, land categories, all make this a feasible offer in each of those markets. So we do see a long-term scaling picture here for sure.
I'd like to see you come out here to Dallas. I work in this arena myself through a fund, the Advanced Fund, and I could see that your model is really going to be filling a huge void, not just in various pockets throughout California, but all other pockets throughout the United States. Have you given thought to coming east?
We have, in fact. To me, I see this being a national story, right? The ever-changing marketplace in urban, and I'm being very specific to urban marketplaces when I make this statement, but if you look at the housing markets across the United States, urban housing markets, and look at the increase in rents and for sale prices, but we're focused on rents here, relative to moderate income family incomes, which are basically flat, and I think that's a well-known statistic. Our product type really it bridges the gap between this rising housing price and flat income area of the marketplace. In other words, middle income families are being dropped ever further down the food chain in housing markets, right? So they're having to rent worse housing, or they're having to bring more folks in to occupy a certain size unit, or they're living further out. So our model basically gives these families the capability to live close into town, which usually is going to be closer to jobs, probably more coherent with their social network, so kids in school, extended family. But we also make it affordable and coherent with their middle income, and that's again 80 to 120% of median income. And you've read like I have. We've even talked about it a little bit offline, but affordable housing as a concept and the need for more of it is really in every market. I mean, I've even tracked articles that talked about Dallas and Austin needing affordable housing, and really, again, housing for working families. In other words, those who make too much to qualify for true government subsidy, yet need and want new housing opportunities in the places that they already live. And that this UTH model really is providing that in an almost wholly uncontested part of the marketplace. There's almost no competition for us presently, which we enjoy. We're also realistic enough to know that there's folks who will follow on, but we are in conversation with capital sources and looking to always grow our networks of capital capacity, that we would like to take this this product on a national scale.
What is the internal rate of return that you're issuing for your investors?
So it's a great question. I'm going to answer it two different ways. So in our original part of the plan, we did the demonstration phase, which I alluded to before, and that was purely a merchant build model. So think build it, rent it, sell it. And on that phase of projects, we generated 22.6% total rate of return on a programmatic basis across the projects that we developed in that early phase. Now, though, we're converting to a long-term hold model, and we're doing that for two reasons. One is corporately and philosophically, we want to hold these assets long-term because we're such believers in the product and these families that we think this is a long-term story. I don't see this housing constraint, undersupply story being resolved for decades, and particularly in California, I think we're looking at 20 to 30 years before this market could catch up, and maybe never then. So we like the viability of long-term hold, but also, we're like anybody else. We're looking to anticipate the recession, which we're in the longest extended marketplace, upward marketplace in U.S. history economically, related to the economic cycle. And so we want to be prepared for that. So we're raising capital on 10-year hold basis, which we feel will be comfortably getting us through a recession that is somewhere between 3 and 7 years from now, get us enough time to come out the backside of that recession, recover value, have a defensive strategy for investments. But if you look at particularly in California, rents were exceptionally stable through the 2008 recession. And so with this family type, meaning middle-income families that have strong social networks locally and an undersupply story, we think this is an exceptionally defensive, meaning protected, safe investment zone. That's why, again, we want to hold them long-term. So what we're offering right now in our long-term holds is about a 15% average internal rate of return over a 10-year hold, but particularly we're generating a 3x multiple. So the returns on your dollar for dollar return of capital basis on a multiple are really good. And then also, again, the safety, like it's a very defensive, undersupplied marketplace. And so we think that the returns are, relevant, coherent to, attract capital. In fact, are coherent. We're attracting capital on a regular basis on our new projects.
Great. Scott, thanks for being a guest on today's show. It was great talking to you.
Yeah, thank you, Michael. Good to join you.
You're welcome. All right, you've been watching CEO Money with Michael Yorba. Thanks for joining with us. Don't forget, download our app on iOS and Android. We'll talk to you soon.